Welcome to the Apartment Investor Show, where we help you get smart and invest smarter in multifamily real estate. I'm your host, JC Castillo, founder and managing principal of the Multifamily Property Group. And joining me as always, fresh from Hawaii, just a little bit sleepy-eyed, but doing okay, Mr. Paul Peebles, national underwriter for Old Capital Lending. Paulie, how are you feeling today?
Not so fresh, JC, but
Yes.
been on an airplane for 9 hours. As you know, if you ever travel over the nighttime, it's very difficult to sleep on the airplane. So traveling eastbound from Hawaii to Dallas and changing planes in Los Angeles is very, very tough. But at the office at 9 o'clock, and we just keep going. So,
Well, Paulie, thank you for powering through. And, today we are going to talk about a pretty timely topic, Paulie. Today we are going to talk about how to protect your lead in a late inning economic cycle. And, Paulie, the reason it's timely, why don't I let you talk a little bit about that?
Well, a couple different things that I think are on the top of our minds right now. One is that we're seeing a little bit of an inverted yield curve, again, where interest rates longer term are actually lower. So the long-term, 10-year treasury is lower than the short-term rate. And so that's a little bit of a sign of a possible recession that's coming up and what type of an impact that's going to have on multifamily. So, we're not seeing a red flashing light. If this was red, yellow, and green, green has been for the last, say, 7, 8, 9 years. And that's been just a huge green. And now I'm seeing a little bit of a green, but I'm also seeing a little bit of a yellow flashing light. So I think that's something that we have to kind of understand in this part of the cycle. If you own the real estate, you were buying A, B, or C properties. Again, A properties is not the people probably listening to this podcast. It's just not. I mean, we're not institutional buyers, but the B and C typically are. And we've been buying a lot of C property. So we're going to talk a little bit about how to protect ourselves coming up into a possible recession. And one of the things is that with JC's been through it for, since the Great Recession. He was an apartment investor, so he has some great knowledge to share with you. That's one of the things that we don't talk a little bit about is that people have a history of how to get through it. It's kind of tribal knowledge. JC's a good person to listen to about that. Of course, I've been through it numerous times, being a lender for the last 35 years on apartments. Is that you have to understand a little bit more about what's going on and what the background is. So how do we protect ourselves, JC? Can you give me like 3 or 4 different ideas that's on your top of your head?
Well, absolutely, Paulie. I mean, I've got 4 for you today, so I'm going to exceed the bar, like I always try to do, is set the bar low and exceed the bar. So we've got 4 actionable steps that you can take if you're a passive investor or if you're an active sponsor, 4 steps that you can take to protect your lead in a late inning economic cycle. And, Paulie mentioned it, right? I mean, look, I am one of those few birds that have been through a significant downturn. The recession, obviously was the biggest in a last large number of years. And so I think that, what's really important out there is, look, we're not here to say that the sky is falling. And we're certainly not here to say that. We are slow and steady wins the race type of people. And we're still doing deals out there, albeit a little bit less frequency now. But what we are saying is that if you haven't been through a recession, you may have a little bit of a rose-colored lenses on your goggles. And when you've been through a recession, you sort of, not only do you see the upside in the market, but you also sort of more importantly looked for the downside in what can go wrong just as much as what can go right. And I think that's what we really want to talk about today.
Right. Just like, can you expect concessions coming up here? Can you expect physical vacancy to have an impact onto your property? The people who actually live on your property, are they actually paying rent? There's a lot of things that we're not going to have a chance to go through everything, but I just want to have people think with this possible yellow flashing light about on their deal. So let's get
That's right. Let's get right into it, Paulie. Let's talk about it. So, the number one way that we're going to talk about today to protect your lead in a late inning cycle is to move up in asset class, right? So Paulie mentioned it, right? We're not doing new properties. We're not institutional investors. That's not how we make our money. We're investing in solid C and B type properties.
Right.
If you sort of look at the last several years, investing in a C property has been the most profitable of all of the asset classes. And so a lot of people that are buying C properties out there should take a step back and say, look, what should we do moving forward with a looming recession potentially? And so what I recommend is that you move up an asset class. Okay, if you think about it, a C property is going to be rented by a very, very blue collar tenant base. And so that tenant base is already paying, historically speaking, the highest rents they've ever paid in all these metros. And so if they're already affordability constrained in a healthy economy, if we have a recession hit, you can imagine that those renters who are barely scraping by now and who live paycheck to paycheck, let's face it, are really going to have a tough time making rent if they lose their jobs or one or two of the people in their family household loses their jobs. And so if you think about it, if you've got a very heavy C-class portfolio, you're going to be a lot more exposed in a downturn than you would be in a healthy economy. So really think about moving up the stack into a B asset. A real solid B asset would be something that's built in the 1980s or newer. And you want to go look for something that is in a little bit nicer of an area. So if you've got a newer product, what's going to happen is your tenant profile is going to be more of what we would call a gray collar tenant base. And so maybe not necessarily working for Google as an engineer, that would be white collar, but certainly, having a little bit more of job stability and maybe a few more dollars in the bank in the case of recession. And that B class resident at your B class property is going to be able to withstand an economic shock a little bit better than maybe say your paycheck to paycheck blue collar resident. So definitely think about moving up an asset class as our number one tip on how to protect your lead. Paulie, the second thing that we can tell you from experience about how to protect your lead is that you want to choose locations for investment that are quality locations in really, really big metros, okay? Let's talk a little bit about that, right? So if you're investing in a tertiary or a secondary market, right now you may be thinking, look, I'm going into a tertiary market or a secondary market because the cap rates and the yields are fantastic, right? I'm making great returns. Well, there's a big reason for that, right? It's all about risk versus reward. The reason why a tertiary market is giving you better yields is because you're taking on more risk to make those returns, okay? If there's an economic downturn in a tertiary market, you're going to be investing in an area that's typically going to have less population growth, a less diverse economy, and less job growth. And so if it's let's say a one-trick pony with maybe one or two major employers in a smaller city, and in the recession, one of those employers sort of bellies up or isn't able to support the economy, suddenly you've got a whole bunch of renters that aren't going to be able to make rent payments at your property. If instead you're investing in a huge metro, a nice metro with top-notch population growth, top job growth, and a very diverse job market, if something goes wrong in one particular industry or one particular segment, that metro's got enough scale to make up for that one segment being down, and you should still be able to make it through the recession. So really what you want to do, your number two thing you want to do is you want to go to a quality location in a big metro. And when I say big metro quality location, I'm not just talking about the big picture, say for example, Dallas-Fort Worth, for example. I'm talking about actually going into the sub-market and even the micro market and thinking about strategically where you're buying inside of those big metros. So to give you an example, when a recession hits, you're going to see a slight dip in potentially occupancy. There's going to be a couple people that are going to lose jobs. And so what happens is the renters or the customers are going to have more power in that sort of an economy where they're going to be able to pick and choose where they live a little bit more than they would have when your properties are at full occupancy. So if they're able to pick and choose, all things being equal, they're going to choose to live in a much better micro market or a much better neighborhood. So make sure that you're buying a property in a great neighborhood, because when the recession happens and people have choices, guess what? All things being equal, which they will be because everybody's going to be competing for the same customers, they're going to choose to live in a better micro market or a better neighborhood. So again, move up an asset class and also make sure that you're picking a quality location in these larger metros. Number three thing I want to talk about is make sure on your financing stack, on your capital stack, that you are securing long-term debt with very low leverage or relatively low leverage. This is a big one, folks. In the recession, I saw people get creamed. And if you look historically at the Great Recession, what happened, these properties didn't go 50% dark, at least ones that were being operated, normally didn't go 50% dark. They maybe saw a few percentage points decline in occupancy. But really what did a lot of people in during the Great Recession was they had a really short-sighted outlook on how they were going to be going in and out of that property. So they had a really short loan window. They had really, really high leverage, and they were just banking on the fact that that property was going to definitely go up in 2 years, and they were going to be able to sell it and make boatloads of money.
Yeah,
And we
just
all
like
know exactly what happened, right?
yeah. So just like in this, there was subprime for single family homes. There was subprime for multifamily properties too, and they had the same like 228, 327 type of loans. So that everything they touched went up. Just single family, multifamily. Well, that wasn't the truth, and so you never wanted to do a multifamily loan on a short-term maturity in these properties. And so it wasn't the occupancy, it wasn't the NOI, it was the short-term maturity, which hurt a lot of apartment investors. So that's why we're kind of banging the table on trying to go long as you can on the term itself, whether it's 10 or 12 year fixed. That's the best way to do it, because if you do have some type of a slightly decline of NOI, you can carry this on so you don't have a maturity coming to you at a bad time. So think about trying to go to long-term permanent fixed rates if that's possible. Number 4, JC, what is that?
Well, number 4 we're going to talk about is we're going to recommend that you really work hard on tightening up your operations. Okay. A lot of people actually don't really talk about operations as part of the overall multifamily business, but operations are super critical, right? Number one thing we always try to do is buy a good property. Number 2 thing we try to do as value add guys is make sure we reposition it properly. But once you buy right and you reposition properly, operations, if you're going to hold a property for 10 to 12 years, let's face it, it takes you 2 years to renovate and reposition a property. So that means you got 8 to 10 years left of operating it the right way in order for you to have a very profitable business. Because at the end of the day, these businesses, these apartment complexes are businesses. They have to be operated properly to be able to turn profit. And so I think what we would recommend to all you investors out there, whether you're a passive investor that's working with sponsors, or whether you're a sponsor that's actually either having your own management company or that's contracting a third party, is make sure that your operations are being done efficiently, right? And if we think about it, operations goes back to good old-fashioned customer service, right? We have our own management company. We're fully integrated here at Multifamily Property Group, and so we always tell our people that look, these are not your residents. These are your customers, okay? And the difference is very important. It means that customers have a choice. They can take their business somewhere else. And so you've really got to be making sure that whoever's managing your properties is doing the right things to take care of your customer, okay? Work orders have to be completed on time and completed the right way. They've got to get the right service when they need it. They've got to have service with a smile. You've got to have happy people taking care of your customer. So really, these are some basic blocking and tackling things on the operations side that you have to pay attention to, because they become a lot more critical in a downturn. Because to be honest with you, in an upturn, in an economic cycle on the up, a lot of these problems get masked by full occupancy, right? So if a customer has nowhere else to go and they have to use your product, then of course you can have bad customer service and they're probably still going to rent. But believe me, when the economy turns, if your operations aren't good, you're going to suffer. The other thing about operations, when I say tighten, is there's only 2 ways to tighten it from a financial perspective, right? You've got your revenue, which is your renter income, and you've got your expenses. So pay attention to how the expenses are being allocated. Make sure that you've got an efficient operation on the expense side, and make sure that you're being efficient with how you're collecting your income, right? Income is tenants paying rent. It's other income like billing back for utilities. It's late fees. It's all that stuff. Make sure that your operations are tight, because that's going to be the number 4 way that you can protect your lead in a downturn. So if we can kind of review those things, Polly, we've got number 1 is make sure that you move up an asset class. Number 2 is choose quality locations in a big metro to really protect yourself. Number 3 is make sure that you secure long-term debt and make sure you don't get over leverage, right? Maybe 70 to 75% leverage. You're probably going to be seeing most of the time for long-term debt in this market. And make sure and tighten up your operations from a management side so that you can make sure that you're profitable through a recession. So, Paulie, those are the 4 ways I think that we can tell people to kind of help them get over the hump if we do see a recession coming up.
That sounds good. JC, you're an apartment syndicator, which means you take some of your own money and you use other people's money as limited partners to invest into properties. If somebody wanted to get more information about what you do and get to know you a little bit better, what's the best way for them to get in contact with you, JC?
Well, Paulie, we have been doing this for a very long time, and we are we've learned a little bit along the way, and so we are always happy to help anybody that we can and give them good advice on how to invest properly and how to do the right things from a multifamily investment perspective. If you're interested in scheduling a free 15-minute consultation with our company, you can go to our website at multifamilypropertygroup.com. Go to the Contact Us section of our website and request a 15-minute consultation, and we will set something up with you, and we would be happy to sit down and see how we can help you out. And you'll most likely be meeting with myself if you set up that meeting. So absolutely do reach out to us. We're happy to help. Paulie, what do you got going on your side with Old Capital?
Education is probably the biggest thing about what's going on. Learn as much as you can. The second thing is network. So the 2019 multifamily conference for Old Capital is at the House of Blues, October 24th, 25th. We'd love for you to come in and meet, say, 600-700 people. That will be at the House of Blues on October 25th. 24th is a cocktail party, great networking event. 25th is all day. And the theme this year is really taking care of business and doing the right thing. So doing the right thing, we're going to have our keynote speaker is going to be Coach Lou Holtz. Coach Lou Holtz is coming in. He's going to spend 45 minutes to an hour talking a little bit about doing the right thing. That's doing the right thing for your investors, for the property, to your lender, and quite honestly, for the customer, your tenant. Make sure you're doing the right thing. So we want to take that and talk a little bit about it. So go to oldcapitalpodcast.com, oldcapitalpodcast.com. Come on down to Dallas, reserve your ticket, come on and see us October 24th, 25th. We'd love to see you then.
Paulie, I'm excited about that conference. I will be there, and I can tell you from personal experience, having gone to several of them, that this is a conference not to be missed. If you are a passive investor and you want to meet people that are doing deals that you can maybe invest in their deals, you're going to find people there. If you're an active sponsor and you're looking to actually do deals, you're going to find a whole ecosystem of basically, from my experience, every single power player in DFW and in Texas in general, and maybe even in other markets, are going to be at that conference. It's something that you need to go to. Make sure you do check that out. And I will be there as well.
Sounds good, JC. We appreciate it. Hey, thanks for everybody listening to us today. Again, yellow flashing light towards a green light, not a red light, but just kind of doing the right thing for your investors and for you. You worked hard for this money. Let's make sure we keep an eye on it. We don't want to see anybody lose any money. So let's just keep going, and we'll see you next week. Thanks, JC.
Thank you. Signing out.